So I'm going to now hand over to Seugnet de Villiers. Seugnet is fortunately in my team. She's a great person, hard worker, very bright, and she has a particular interest in behavioral finance specifically, and spends quite a lot of time talking to clients, talking to advisors in terms of trying to improve their investment performance through correct financial behavior. And she will really be talking through, do clients have enough risk in their portfolios? Because once again, we see in March during the COVID crisis, when markets are falling, people's anxiety increases. They tend to move into cash and cash-like products, generally at the wrong time, and miss the up part of the market. So Seunet's got some quite nice information and slides on this. And so Seugnet, I hand over to you.
Great, thanks, Trevor. And yes, as you said, I'm fortunately in your team, even if you have to say so yourself. Right, my topic for today's discussion, do clients have enough risk, or let's call it growth assets like equity in their portfolios, I think is such an important question to be asking all clients at the moment, because actually over the last 5 years already, clients have definitely been de-risking their portfolios. Here I take a look at the total assets under management over the last 10 years of the 4 largest CISA categories, excluding the money market category. And this de-risking trend is very clear. So the first thing I want to highlight here is 10 years ago, the equity sector, so SA Equity General, was 37% of the assets under management of these 4 categories combined. Today, it's only 21%. The multi-asset high equity category, so your max 75% balanced fund, had good growth over the first 5 years, but has practically gone nowhere since. And the multi-asset income category, which is only 10% equity, has been the only category that has grown in relative market share over the last 5 years. If we look at the cumulative net flows over the last decade, it really tells the same story. So the chart on the left shows you the cumulative net flows from the 1st of July 2010 to the end of June 2015. Over this period, the multi-asset high equity category was the clear winner, while the multi-asset income category practically went sideways for a big portion of this period. On the right-hand side, I show you the cumulative net flows over the last 5 years. Here, the multi-asset income category was the clear winner, and actually all 3 of the other categories has had net outflows over the last year. Now, I think a big reason or a big driver behind this de-risking that we've seen over the last 5 years has been relative performance. So on the left-hand side, I show you the annualized return over the first 5 years of the respective categories' averages. And that really is a perfect textbook picture. The higher the equity exposure in the category, the higher the return, and the multi-asset income category delivered the lowest performance. The last 5 years has, however, been a difficult period for domestic growth assets. And if you look at the bars on the right-hand side, it's the complete opposite. So the multi-asset income category has been the top performer, while your pure equity exposure delivered the worst performance over the last 5 years. And I think what then made things even worse, or what made it even more difficult to have that conversation with clients about including equity and including growth, is of course the impact of the global coronavirus crisis. So this chart shows you, with the green shaded area, the global volatility index over the last 20 years. And I just show you what the equity market did with using the MSCI World Index over the same period. And what I find very interesting is just how history shows us time after time that so often when volatility is at its peak, in other words, when it feels like the worst possible time to invest, the market actually delivers a very good performance after that. So with the exception of September 2001, you'll see every time the global volatility index reached more than 45, the subsequent 1 year return was double digits. 2020 was no different. We saw the global volatility index reach 83 on the 16th of March, And since then, the equity market is already up 43% and back to or even higher where it was before the crisis. And this is such a big opportunity cost to clients who panic and who think, oh, this feels terrible, I can't be invested, get me out and get me back into cash. And this really brings me back to what for me is a very important question. Should all clients currently invested in the income space remain invested in the income space? Or are some of these clients in there for the wrong reasons, like chasing short-term performance or panicking about the current market conditions and uncertainty? Now, to answer this question, I actually want to share with you what I learned at my very first photography lesson a few years ago, because I do actually think there's a very high correlation and it might be quite a useful analogy to use with clients. So when you take a photo with a DSLR camera where you can control your settings, you've got 3 settings to work with. You can control your ISO, which is a sensitivity to light. You can control your aperture, which is how wide the lens will open. And you can control your shutter speed, which is of course how quickly the shutter will open and close. And when you take a photo, irrespective of light conditions, irrespective of weather, these 3 measures have to be in sync. There's a certain relationship that needs to hold between these 3, because if it doesn't, and if it's out of sync, your photo would either be too light or too dark, because you're letting too much light or too little light in. So if you change the one setting, you have to compensate for that by one of the other 2 to maintain that relationship and that balance. Now in the investment space, let's call it same trilogy exists with time, risk and return. And it's so important when you have that first conversation with clients or when you do a review of a client's portfolio to always make sure that these 3 are in sync. Just like taking the perfect photo, the relationship between a client's specific time, risk and return needs has to be in sync. It has to be in line in order for the resulting exposure, which in the investment world is asset allocation, to be suitable. So the more time a client has, the more risk or exposure to growth assets the client can afford, and the higher the return the client can expect to achieve. However, if the client's time horizon is shortened, the risk and the return has to also be adjusted. It has to be reduced. Or if a client has a specific increased return requirement, you have to increase the time you stay invested and you have to increase the growth exposure that you include in the portfolio. And here I show you a very basic chart to just re-emphasize the importance of asset allocation. So on the left-hand side, I very simply illustrate what has the equity market done versus bonds versus cash, and these 3 relative to inflation. Now, if we first look at the equity performance versus the bond performance, it's close to double over this 20-year time period, and the equity market has delivered almost 3 times that of the cash market or the cash index over the last 20 years. But the other very important point and the very important conversation to have with clients when you talk about growth and the inclusion of growth is the purchasing power growth that it offers. And I find a useful but silly analogy to be, what can you afford in terms of, for example, cars? So if we assume we had 2 clients who could both afford a City Golf 20 years ago, client 1 decided, let me invest in equity, and client 2 decided, no, I'm too scared, I want to sit in cash instead. If we fast forward 20 years, the client that invested in equity can most likely now afford something like a Range Rover, or the client that chose to invest in cash can only really upgrade from a City Golf to, let's say, a Polo Vivo. So really silly analogy, but I think so powerful to just remind clients what the opportunity cost can be if you choose to invest in equity or in cash, if you have the time on your side to invest in equity instead. But I think the very important, most important rule is definitely sticking to the plan. What you can't do is say, yes, I've got a 7-year time horizon and let's call it change your mind 1 year in. It's so important to, irrespective of market conditions, irrespective of short-term volatility, just remain invested, because the flip side of this brilliant growth that equity offers over the long term is volatility in the short term. So funds with an equity exposure can and will deliver weak and even negative performance over the short term. And by short term, I'm referring to a rolling 1 to 3 year period. What I illustrate on these two tables is the average performance of the 4 CISA categories we're working with, rolled on a monthly basis over the last 20 years on a 1, 3, 5, and 7 year measure. The top table, I illustrate how often are these rolling 1, 3, 5, and 7 year periods positive. On the second table, I show you how often is the return achieved over 1, 3, 5, and 7 years greater than that of money market. And the common theme in both tables is just the massive improvement in likelihood of success the longer you stay invested. So yes, over a 1 year period, funds with equity exposure can deliver negative performance. Yes, over 1 and 3 year periods, there has been many times where an equity investment was worse than a cash investment, but over its appropriate time frame, your likelihood of success is very close to 100%. And then the next question we often get asked when talking about growth is, or equity exposure, is what about clients retiring? How do we manage their portfolios? How do we include equity? Do we include equity? The short answer for me is there's no difference almost. The same investment principles apply when managing a client's retirement portfolio, because remember, it's still a very long time frame. But what I've done here to try and illustrate the role of growth even in clients already in living annuity is I used the Nedgroup Investments Big Picture app, which feeds off monthly market data since 1926. And I looked at 3 scenarios. I said, let's assume we have a client retiring with 3 million Rand, and this client is planning either for 20 years, 25 years, or 30 years. The other thing that I looked at is what's the impact of the drawdown rate. So I looked at the impact of the client's success when he draws 4%, which is a starting monthly salary of 10,000 Rand, all the way up to a drawdown rate of 9%, which is a starting salary of 22,500 Rand. I then use the Big Picture app to calculate the likelihood of success. In other words, how likely is it that your 3 million Rand will last for your retirement when you invest in income, low equity, high equity, or pure equity funds. The asset allocations in these funds are, let's call it standard or average exposure of those categories, subject to the limits of the CISA category. And there's a few things that I want to highlight here. I think first and foremost, what's very clear is as you move from income to low equity, high equity, and equity, in other words, as you move up the risk spectrum, the client's likelihood of success at a 4 and 5% drawdown rate is very good. So if you look at the right-hand side of the tables, a client drawing 4, 5, or even 6% invested in a multi-asset high equity type solution has a pretty good chance of having a successful retirement. The 2 things that materially detract from success is the exposure to income or the lack of exposure to growth assets throughout this 20, 25, or 30-year period. You'll see that clearly with the likelihood of success dropping all the way to 0% actually when the drawdown rate increases. And then the other big detractor is, of course, the drawdown rate. I think one of the biggest differences clients can make in retirement to their success is being as frugal as possible with their money and managing the drawdown rate as tightly as possible. And just to wrap up, I want to just reiterate some of the key points I made in today's presentation. I think firstly, the basic investment principles are true and should be used for portfolio construction irrespective of market conditions. And for that, I think time frame is definitely the starting point. So it needs to be a key driver of the resulting asset allocation for a client's portfolio. That asset allocation will then always be the key driver of the short-term volatility and the long-term growth a client can expect. Emotional reactions can be extremely detrimental to a client's portfolio. The opportunity cost can be significant. And as we've seen in the past, so often when the temptation to switch is at its highest, the timing to switch out of equity into cash is probably at its worst. So managing that emotions in times of panic is such a critical value add for the financial planner. And then I think maybe just to summarize the answer to my question, to my discussion today, or my topic, is growth assets like equity really play such an important role, both pre and post retirement. But I would say with the disclaimer that it's included for the right time frame and that a client sticks to that investment plan. Thank you, Trevor. I hand back to you.
Great. Thank you so much, Sune. That was very informative. And the good news for you is that I think you're going to get off one or two questions just for us to keep on the time track. But I think the message that you gave is absolutely vital, and really, yeah, if the role as a wealth manager, as a financial advisor, I think the biggest value that you can add is really managing your clients' emotions, managing their investment behavior, and in that way you can make a massive difference on their ultimate investment performance. I thought a couple of little pieces of information. We've got just under 400 people on the webinar today, which is amazing. So thank you everybody for dialing in. It's pouring with rain here in the Atlantic seaboard of Cape Town and freezing cold. So I'm not sure the weather throughout the country, but our dams are certainly getting close to, I think, 100% full. And lastly, I see the Rand has weakened by about 10 cents since the webinar started. So I'm guessing investors were listening to Nikki's presentation.